In our last voiceover, we talked about the journal entry, which is done right before the financial statements are prepared, which is a debit to bad debt expense and a credit to our allowance account, which is an allowance account related to accounts receivable. But we didn't talk about how you determine the amount for that journal entry. So this voiceover is primarily a discussion of the way we come up with that number. So there's two major acceptable methods of coming about this number. The first method is percent of credit sales. This is an easy method to apply. So every month we go in and we say, oh, we have so much in credit sales, and what percentage of our credit sales do we typically not we are unsuccessful in collecting on. So what is the percentage of our credit sales we typically don't collect? And it could be 3%, it could be 5%. Those are typical numbers for retailers. So 3%. Then every time before we do our financial statement, we're going to record bad debt expense, and it's going to be 3% of whatever our credit sales were for that month. So we've got our financial statements ready to go. We have a total credit sales number in our financial statement. It's not difficult. It's simple to do this. We go in, we multiply it, determine what it is, debit bad debt expense, and credit the allowance account. The other method, which is more accurate, is to have someone go in and analyze those accounts receivable and look at those accounts receivable and figure out, which of these does it look like we're going to be able to collect on and which we aren't going to be able to collect on, and make sure that the allowance account is equal to those uncollectible estimates in our accounts receivable. This percentage of credit sales method is matching. It's matching because we're looking at revenue and we're estimating the expense associated with the revenue. So it's the matching principle. So technically, that's a very good way to do it if you think it focuses on the income statement. The aging of accounts receivable, it may be a little more accurate, because what we're really talking about with that one is looking at the balance sheet and saying, well, what should we show as the value of our accounts receivable? What do we really think we will be able to collect? Because accounts receivable itself is an overestimation of what we're going to collect. So we have to think about what should it be. And this is the aging of accounts receivable method. So two methods in this: percentage of credit sales and aging of accounts receivable. The percentage of credit sales method then is very simple. Let's say we have 3/4 of 1%, our bad debt loss rate, which by the way is very, very low. We're going to multiply that by the 120,000 sales we have for the month, and we come up with $900. And when we have the $900, then we would record it as bad debt expense and credit our allowance account. So the same company we were talking about before, VFC, expects 3/4 of 1% of credit sales to go bad. They base this estimate on what they've seen in the past. So it's very important that you understand here that a company has to keep track of this, and they have to justify recording 3/4 of 1% as their bad debt expense. They can't just come up with some number and record it as bad debt expense. They have to base it on what they've seen in the past, because the auditors will come in and they'll say, is this right? How do you come up with this number? So they've looked at the past, they keep records, and they estimate the bad debt is going to be 3/4 of 1%. They have credit sales again of 120,000. They multiply it and they come up with bad debt expense. So they just record bad debt expense and they put it in this contra account, allowance for doubtful accounts, allowance for uncollectible accounts of $900. So the $900 is going to be an amount that's going to reflect the uncollectible amount of the sales that they have made in this time period. The aging of accounts receivable is a different method, and it's a method which takes its basis in looking at the age or the amount of time that has passed since the sale was made and that the customer has not paid. We don't know if they will pay in the future or not, but we do know that customers who do not pay their bills every month as they become due, remember we're sending the statements out to them, we know that if they don't pay us, then it's more likely that they will not pay us in the future. So customers that pay their current accounts, that is their first billing goes out to them and they pay, those are good customers. But if it takes 2 statements to go out to them before they pay, then it's more likely that they won't pay. So the older or more overdue an account receivable becomes, the less likely it is to be collectible. So VFC then applies the aging of accounts receivable method to its balances after taking into account the sales and collections. So they go in and they look at the end of the month and they say our accounts receivable stands at this number, and then they put their accounts receivable in the categories based on the time from the date when it should have been paid and it's now not paid. So this first one, for example, is from Adam Sports. This is the name of the customer. The customer owes us a total of $700. $400 of it is in from purchases that have been fairly recent, 0 to 30 days, and $200 is from purchases 31 to 60 days ago, 100 from 61 to 90 days ago. So when we look at this, we're going to say, well, why haven't they paid this? Because technically with this, you probably have received 2 statements and they still have not paid that balance. This we're not so concerned with because part of it may not even be due yet. There's a little concern with this because it's up to 60 days since they made the purchase and they haven't paid, but more concern over here. And so first thing we're going to do is we're going to take every customer's account and we are going to try to categorize or put these sales into the number of days unpaid into buckets. Okay, so we're putting them into buckets. If you notice with Momentum Close, their account is over 90 days unpaid. So 3 months. They haven't paid us in 3 months basically. So the first step is to age our accounts receivable. You age it by taking an accounts receivable balance and putting it into each one of these buckets. Now this could be done very easily with your accounting system, so it's not something that has to be done manually. We're not going to have to go through and look at every single sales ticket and figure it out. It's something that's probably programmed into our computer, and our computer gives us this. Our second step is to estimate our bad loss percentages based on each category, so in the number of days unpaid. As we said before, if it goes out to 3 months and this customer has not paid on it, there's a greater probability, here it's a 40% probability, that they will not pay versus 20%, 10%, and only a 1% probability that they're not going to pay if they're keeping their accounts fairly current. So you categorize each one of those amounts into the buckets, and then you use your estimation of what amounts in each bucket will not be collected. When you multiply these numbers, and this is the total accounts receivable, so you're not going to calculate it for each individual accounts receivable. You're just going to do it based on total accounts receivable. You have the 208,000 put into all the buckets. You multiply a percentage times the amount, the total amount in each bucket, and then you add across here to get your estimate of uncollectibles. Now this number is an estimate of the $208,000 that's uncollectible. It's not an estimate of the bad debt expense, which is based on sales, which we had in the previous method. This is based on the percentage of our accounts receivable, or part of our accounts receivable that we don't expect to collect. So you can see from this, when we show our accounts receivable using the aging method, we need to show it at $208,000 minus $15,500. So that's a balance sheet. This is a balance sheet approach, whereas a percentage of sales was an income statement approach. So this computes our number at $15,500. Now, the tricky part of this, we said this was a more complicated method, is that we don't just do bad debt expense allowance for a dollar amount. We have to go in and we have to ask ourselves, what is the balance in the allowance for doubtful accounts today? So, go in, and you're ready to do your financial statements. You go in and you look at the balance in your allowance for doubtful accounts account. It's a balance sheet account. It doesn't zero out, so it has a balance. And you know that the balance should be $15,500 based on your analysis of the $208,000. So you say, what do I need to do to make it $15,500? And I think we can look at this and we can say we need a credit of $1,300, can't you? $14,200 plus $1,300 would make it $15,500. So we're going to go in and we're going to do a journal entry, and our journal entry is going to debit bad debt expense and credit the allowance for doubtful accounts for $1,300. After we've done that, then we have an allowance for doubtful accounts that will show $15,500, and this will be the amount that will show up on our balance sheet. And so we will have done that properly. Now, the bad debt expense is just going to be a kind of a byproduct here, because our focus is on getting this allowance for doubtful accounts to the proper balance. That's the total focus on it. There's a few other issues related to this. Generally, your bad debt expense is an estimate, and it's not going to be accurate. It's not going to be perfect. I think in the previous slide we had 900 versus 800, and I said, well, maybe the other 100 will come in later and it'll be fine. Generally, a company is not going to be exact with an estimate, because if you knew it, then you wouldn't be making the sales to those customers, would you? I mean, if you really knew which ones weren't going to pay you, you wouldn't make the sale, because you're never going to get the cash. So we know we're not going to be exactly right. We don't have a crystal ball, so it's okay. If it's a big amount, and we call this material, okay, so the expression is material. If it's a big amount that's off, then we need to go back and fix it, and fix our journal entry and fix our financial statements. The other issue we have is, since we have written off an account, we remove that account balance. We have to reinstate the account if that customer did in the future pay us. And so we have an additional journal entry that you have to do if you've written off an account and then they pay us, and that is to reverse the write-off. So when we wrote off this account for Fast Fashions, we debited the allowance for doubtful accounts, and we credited Fast Fashion's accounts receivable to remove it. When we collect it, we need to reestablish the accounts receivable and then remove its balance like we normally do when a customer pays on their account receivable. So there's one extra step you have to do. And I wonder, well, why do we have to do this? Why are we doing all this stuff? Well, in accounting, if you have a credit balance in an accounts receivable, most systems will turn around and send a check to the customer. because they'll assume that the customer has overpaid on the account. So if we don't do this journal entry, which is 1 up here, if we don't do that to reestablish the accounts receivable, our system is going to send this customer $800 back. And we don't want them to send them the $800 back because that $800 is what they owe us. Okay, in our next PowerPoint, we're going to start our next PowerPoint voiceover. We're going to talk about notes receivable and why we would use notes receivable versus accounts receivable.